Good evening, everybody. Welcome back to Strongman Personal Finance. Do you remember that Jeremy Lefebvre, the massive fraud, scammer, liar, loser, degenerate, disgusting, grifting clown, who I attacked religiously? It was my religion. All the way back in 2021 and 2022. Do you remember old Jeremy Lefebvre was pumping this stock called Corsair Gaming? Well, I like to go back after a couple years and see how some investments aged. And while everybody makes mistakes with stocks, I find it hard to forgive a mistake from somebody that used to charge up to $20,000 to teach people stock investing. I'm not joking. This man, Jeremy Lefebvre, had a windfall of disgusting grift profits in 2021, and I guess 2022 he started to collapse. But in 2021, he basically had a huge windfall of grift profits because we were in an insane bull market fueled by free money, easy money, basically. And this gas station manager, gas pumping loser was able to convince people that he was a stock investing genius. And one of the stocks that he invested in was Corsair. He was super bullish on it. So let's watch this clip, and then we're going to see that Corsair is not doing too well.
Because the small caps have already been devastated so bad, okay? And so this is an 80 to 90% probability that I think the stock's going to bottom somewhere around essentially where it is now.
Okay, 80 to 90% probability it's going to bottom. Because when you're a YouTube scammer, you literally just pull numbers out of your butt, you say it with conviction, and the losers believe you. This is why index funds will work in the long run. Because of people like Jeremy.
Just go maybe a little bit lower and then start to make its move up, okay? And so that's Corsair Gaming. Now, as far as me, this is my number one stock. I want to be very, very clear. This is my number one stock I am most interested in for call options. There's no doubt about it. Like, if this stock continues around the range it's at now or goes down and those call options are out, it's my number one stock I'm most interested in. So in September, I would say there's an extremely high probability I buy some 2024 call options in regards to Corsair, maybe even in October as well. I might buy a chunk in September, buy another chunk in October, and then maybe even a last chunk in November. It's going to depend upon where the shares are trading at, and also what are the premiums option sellers want out there and things like that. If the option sellers want some crazy numbers, I won't pay it, right? But
Man, and you know he bought these call options. So here's Jeremy basically saying the stock is going to bottom 26, 28, and he's going to buy call options in 2024. We're in 2024, right around the time these would be about to expire worthless, basically, which I'm sure they did. So where's Corsair at now? Well, it's at $6.50, and we're going to investigate why. Now, I criticize this stock, number one, because I don't think individual stocks should be a large part of your portfolio. You can have fun with them. You can screw around. That's fine. Small part of your portfolio. Have a clown account. Have fun. The vast majority of your portfolio should be in total market index funds. I think I've proven that incontrovertibly by crushing this bozo loser in the last couple of years. But, of course, this channel's growing again. But also, Corsair was basically a lockdown stock. Why? Well, everybody got a bunch of stimmy checks during the lockdowns, and they used it to buy a bunch of computer equipment. Corsair provides computer accessories, computer equipment. The stock's revenue went up massively. There was massive explosive growth. Jeremy, because he's a genius, extrapolated that growth forever into the future. And because of that, when the growth actually collapsed, because we're not getting free clown money checks anymore, the stock collapsed with it, okay? So let's go ahead and look at the most recent earnings, because I've been curious about what's been happening with Corsair, because for a brief moment of time, they were profitable. So let's see how Jeremy's amazing stock pick and all the value he provided, let's see how that performed for us. So net revenue was $261 million for the second quarter ended 2024, compared to $325 million, a decrease of 20%. A 20% drop. And this is way after the clown stimmy market. Okay, this is not good. Gaming components and systems segment net revenue was $167 million compared to $246 million. Oh my God, how much did that fall? 167 minus 246 divided by 246. 32% drop. Oh, that's where the big hit happened. While gamer and creator peripherals segment net revenue was $94 million. So basically, oh, actually, that actually went up. Wow. So you can see there's massive losses of revenue from gaming components and systems because I guess people, I don't know, maybe they're not locked down as much anymore as they were before. Net loss attributable to common shareholders was $29 million. So we have a loss margin of negative 11%. Negative 11% or a net loss of 28 cents per share. So for the privilege of owning Corsair, my horsehair, you lost 28 cents in a quarter. Great. Compared to net income of $1.1 million in the second quarter of 2023. Adjusted net loss, don't even worry about it. Cash and restricted cash of $94 million. So they have some metrics here. We're disappointed with our Q2 2024 results, which were driven by softer than expected self-built PC. Who builds their own PC? Just freaking buy one, man. I don't got time for that, okay? Genius Strongman actually called this to a T. The surge of activity during the you-know-what lockdown period, where the number of gaming PCs that were built approximately doubled from the prior year, and headset sales almost tripled. Because we got free checks and we were all locked in the houses. What were we going to do? Play games. Is now at an all-time high. Even with the surge, we are not seeing the market for headsets. Blah, 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 blah. Basically, we had a temporary massive bump that everybody extrapolated forever into the future. Okay? But I'm sure they're, in the report, they're finding a ways to pump this. So the net revenue for the full year 2024, they're projecting to be in a range of $1.25 billion to $1.35 billion. So if we look at the revenue of 2023, that is a worst case decline of, let's see how bad the decline can be, minus, I know we're doing math here. I'm not just going to tell you it's going to 1,000 billion X. So worst case, the revenue year over year declines for the full year 14%. That's the worst case scenario. The best case scenario is, let's see. The best case scenario is our revenue declined 7.5% for the full year 2024 compared to 2023. Unless they somehow beat and only have 6% revenue decline, which would be so amazing. Okay? Good job, Jeremy. Where do I sign up for your Patreon, you loser? But, his channel's growing fine now because, we're back in the AI, my hot guy. So let's see what's going on here. So we know revenue decline. Let's look at gross profit margin. So gross profit is your profit just from selling items. It's the cost of the item. It's what you sell the item for minus the cost of the item divided by the cost of what you sold the item for. So the gross profit would be 63,085 divided by 261,300. So their profit just from selling things. They buy a PC accessory or they produce it and then they resell it. The profit just from that on average is 24%. However, all of their profit gets eaten up by selling general administrative expenses, which has gone up. That's increased. Their profits decreased. Their gross profits decreased pretty significantly. Their selling general and admin expenses have slightly increased. So overall, their entire profit from selling items is eaten up by whoever they're paying. They need to fire people, okay? And we see product development's up pretty significantly. Interest expense, nothing crazy. Interest income. Okay, so we know they're losing money. Let's see if they issued any shares. I wonder if we'll see that. Okay, so now they're issuing shares, obviously, because they're losing freaking money. We know the revenues declined massively. Gamer and creator peripherals, that has the highest gross margin. So let's go back. Which one was the one that declined? Let's see. Okay, the gaming components and segment net revenue declined the most, but that has the lowest gross margin. Okay, so their highest margin part is actually, looks like it had some revenue growth. Let's go back and double check. But that did not compensate for the massive drop in the other segment. Let's see. Yeah, so gamer and creative peripherals are growing, and it's more profitable, but the offsetting drop in the other segment basically destroyed this company's earnings. Okay, let's look at their balance sheet. So they have roughly $282 million of highly liquid capital, and they have short-term debts of $322 million. Let's see. Not the best, but they have more current assets than current liabilities. Basically, half of their short-term assets that will hopefully be converted to cash are inventories. And they actually record a profit from that, so they're going to generate more cash than what you see on here, which is a good thing. So overall, I mean, they have enough. I think they have enough liquid capital, it looks like, to meet their short-term needs. Let's look at long-term. So we got property, plant, equipment, nothing crazy. Goodwill. What percentage of this company's balance sheet is intangible assets? Roughly 42% of this company's assets, quote unquote, is goodwill and intangible assets, basically patents, trademarks, whatever they spent money on, and acquisitions of other companies. 42% of this company's assets. So if we take out the tangible assets, let's see, 1, 2, 3, 4 minus 354 minus 168. They have their actual assets are 712 million, like the actual tangible assets, unless I don't know what these other assets are, but overall, you don't want a huge part of your balance sheet being goodwill, because basically it just means you had a huge acquisition. And it's a plug entry. So let's see, long-term debt. They are paying off long-term debt, I guess. That's good. But you can tell that they took this long-term debt to do some kind of acquisition. It was not used, or only part of it was used to finance property, plant, and equipment. So they have real debt of $168 million, and they have tangible property of $30 million. The vast majority of their long-term assets is goodwill, which is just a plug entry for when you acquire another business, for more than the fair value of its net assets. So not the most satisfactory presence of long-term debt, unless that acquisition actually pays off for them in the future. I don't know. If the cost of the debt is less than that they issued, is less than the profit they get from the acquisition, maybe it'll pay off for them. But we'll have to see. But they've paid off about 19 million. It looks like 19 million of debt. Let's see. I want to see the statement of cash flows. So they actually burned cash in operations. And the reason they did that was they had a loss, of course. They had a loss. Let's see if there's any crazy changes. Changes in deferred income taxes. That's a subtraction. You add back expenses, you subtract gains, or non-cash gains. Let's see. Accounts receivable. So they had compared to the 3 months last year, their accounts receivable had a huge write-up. Basically, if your receivables go down, that means you collected cash, so you have to add it back. Inventories is a subtraction. That means they purchase more inventory. But the purchases of inventory have gone down pretty significantly. Look at the comparison of inventory purchases. Last year, this same time, they purchased $24 million of inventory. This time, they only purchased 13. Could be a timing difference, or it could be they're decelerating their inventory purchases in anticipation of fewer sales in the future. And then the last big difference looks like it's accounts payable. So they subtracted accounts payable because they basically paid off short-term bills for the company. So overall, they had pretty significant negative operating cash flow. We'll see if that reverses in the future. But usually if you have a loss on the accrual basis of accounting and it's not a one-off, I mean, you're eventually probably going to have negative operating cash flow. Unless a big part of your loss is stock-based compensation, et cetera, et cetera. But that's not the issue here. It's more of a balance sheet thing. Let's see. Property, plant, equipment, nothing crazy there. Bridge loan receivable. Okay, they paid off $12 million of a bridge loan receivable. Let's see. Repayment of debt, and they paid off, looks like $3 billion. If you compare the 2 years, $3 billion. The balance sheet was comparing December 31st to June 30th, whereas this is a full year. So in a full year, they paid off $3 billion of debt, and only most of all their shares is just from stock options, basically. So this company's in trouble. Okay, they need to cut their freaking selling, general, administrative expenses. That's the problem. I mean, they have gross profit. It's massively fallen, and their revenue's fallen, which is awful. But they need to cut their selling, general, and admin expenses, obviously. And they're having a huge problem with their gaming components and systems, where their margins in that have collapsed. They've gone down pretty significantly. You can see the change. 23% gross margin down to 16%. And the revenue's collapsing, so it's a collapse of margins and revenue. And their most profitable segment is growing, though. That's the only really bright spot. But overall, I mean, I don't see imminent bankruptcy, but I would pay attention to see where this company trends with their cash position. So that's Corsair. Good job, Jeremy. We're proud of you. You're a freaking hero. Let me buy your course. Have a wonderful night. If you like my videos and financial analysis, don't forget to hit the like and subscribe button. Also consider sending me $50 for a personalized video. I'll talk about whatever topic you want. See the pinned comment below. Check out my book, Stop Being a Broke Loser, on Amazon. And if you want a one-on-one coaching session with me, a certified public accountant, it'll be $75. Pinned comment below. Talk to you later.